From another sunny day here in Copenhagen, welcome to the eTraining Enhancing Energy Efficiency in East Africa, hosted by the Copenhagen Center on Energy Efficiency. My name is Aris. I'm working as a program officer at the Copenhagen Center, and I will be the moderator for today's eTraining. A couple of things before we move to the main content of our eTraining. This eTraining is going to be about 80 minutes long, including time for Q&A at the end. In case you cannot stay until the end or want to get back to our presentations, all the materials and the recording of the whole eTraining will be available in a few days on the Copenhagen Center's Knowledge Management System. And we have many other webinars and information over there. Have a look. Before we start discussing about today's eTraining, I would like to inform our attendees one more time that we comply with the General Data Protection Act, also known as GDPR. This means that your personal data, such as name, email, workplace, etc., is safely processed and stored, and all of your rights pursuant to the GDPR are respected. You have full access to the data being processed about you, and at any time, you can request that inaccurate data be deleted or rectified. For access or further information, please contact with the people that are presented here. A few things about the Copenhagen Center. The Center conducts research and advisory activities in the field of energy efficiency and serves as Energy Efficiency Hub for Sustainable Energy for All initiative. The Center has an established network of global, regional, and national partners with a broad range of stakeholders to help accelerate the implementation of energy efficiency activities. Now, I would like to briefly introduce the speakers of today's eTraining. Jorge has been involved in diverse climate change mitigation and adaptation projects in Latin America. He has a background in climate policy and finance, and he has coordinated climate action plans and clean energy studies with international, public, and private institutions. And Xianli is a senior economist of the UNEP-DTU partnership, and her work focuses on analyzing and designing enabling policies and programs for energy efficiency improvement and climate change mitigation. Finally, I would like to inform that you can send us your questions during the presentations using the dedicated icon, and we will do our best to answer as many as we can at the end. Please do not forget to mention the name of the panelist that the question is for. And now, I would like to give the floor to the first speaker of today's eTraining, Jorge. So, Jorge, the floor is yours.
Good morning, everyone. My name is Jorge Hinojosa, as Aris was saying, and I'm going to start with business models today. After me, Xianli is going to do more on the financing part. I'm going to be touching a bit on financing, like the initial phase, but we're going to be discussing mostly how the business models on ESCOs, super ESCOs, and more models are actually applied to energy efficiency bundling. Because what we want to focus now specifically is bundling, right? So we want to explain the different models. In the end of the presentation, we're going to end up with some renovation and innovative financing schemes that are happening right now, some examples and around the world, and how new revenue models are applied to energy efficiency. So I'm gonna go ahead and start. Well, first of all, the point of having project bundling is to aggregate different segments, right? And what do we mean when we say aggregate? We wanna have many projects together, many municipalities together, collaborating with the point of actually saving costs and having benefits, achieving project bankability, lowering market barriers. This means that by combining projects, we can use economies of scale and then have access to better financing schemes and lower the costs. So this is the main objective of aggregating projects. The point is that several actors can seek the financing together at the beginning. So this is to say that a business model can unlock a larger investment if it's going to be infrastructure on efficiency, on heating or something. It's going to be expensive normally in developing countries like ours. It's actually quite tricky to access finance. So we can use bundling as municipalities or building owners together to access. And then the use of economies of scale is going to help us reduce transaction costs of the projects depending on the financiers. But aggregating many projects and just the basics of economies of scale are a main advantage of this. Then when projects are actually bundled into a single investment portfolio, this becomes really interesting because let's say that we have heating, water, and many energy efficiency projects together in a single investment portfolio. And I'm thinking about a pie chart where 10 projects are, covering the chart. What happens here is that all those projects are going to be financed together. And this means that they're going to share a common, a team and a financing mechanism, and the risk is going to be lower. We're going to see that later on. But this is actually helping with the potential for financing in municipalities, right? We're going to start with the ESCO business model at the beginning. We want to make clear what ESCOs are. You've seen in modules before, ESCOs, my colleagues have mentioned them. The point is that we want to have a company, an energy service company that can provide the upgrades through energy savings. Let's say that I'm a building owner, and I need services. I don't have the capacities. I need financing for 20 years of renovating energy efficiency, installing water pumps or something. And I can use a company that's going to do everything for me. In this case, the ESCO is going to provide me with the upgrades, the technology, the risk management, and even it's going to be an outsource to the company. So it's going to provide me financing. There are many ways of doing this. We're going to see that later. But the point is that the ESCO is going to guarantee me, the owner, savings, energy savings. So we can have a performance-based contract, right? So every month there's going to be a performance on energy, which is going to help me see and visualize how the savings and the performance is actually going, right? So the company, the ESCO, is going to be the developer, and it's going to take care of the project's financing and operational settings, meaning the maintenance every year for the technology, the upgrades that are going to be expensive without the ESCO. And of course, month to month, there can be different ways of payments on my bills, or, we're going to see that, for the projects to make sense economically, right? So ESCOs are going to allow public buildings and facility owners to access larger capital investment, energy efficiency upgrades without bearing all those market risks and technical risks, and lowering financial barriers. What do I mean by risks? I mean by saying, okay, I want to install energy efficiency technology in my building. It's going to be the newest heating technology for the winter. But this is going to be very expensive, and in my area, my community, in my rural area, I cannot access the finance. Or even, all the buildings in my area want to access to some microfinance together, or to some degree of, not so expensive interest rate of finance. So I can opt to hire an ESCO and have a better understanding of a business model for 10 years or something. So we can bundle projects, right? And outsource everything to the ESCO. These companies are going to monitor and verify the energy savings and the performance. So I'm going to be in my building or in a municipality, and I'm going to receive those services. And that's what I'm paying for. And that's going to be happening maybe for a long time. So one of the models that is used for ESCOs is the energy performance contracting model. In this case, the ESCOs are allowed to become service providers and contractors of the bundling project. So EPCs, right, are actually offering owners and sponsors guaranteed performance and energy savings through a contract. So if this energy savings are not happening, there's a contract. Then there are some clauses and things that are expected to be changing. But the thing is that we are going to be guaranteed energy efficiency and the manage of this by the ESCO. And of course, when the energy savings are guaranteed and the project is going, the ESCO is going to be able to repay the project investment costs. It's going to be able to finance this because the ESCO is a company that has the ability to help you with that, right? The next model, the next EPC model, is a shared savings EPC model. So here, under this specific ESCO model, what happens is that the ESCO, the company, takes care of the financing instruments with all the financial institutions and investors, and the ESCO is going to finance the client. So the building owner hires the ESCO, but the building owner doesn't need to take care of those, loans and equity instruments or combinations of things to make this project make sense on the Excel file, right? So the ESCO is actually making sense of this. And the savings, the energy savings, month by month, are going to be used by the client to pay the ESCO, who will actually repay the loan to the bank or to the main investor. So one of the advantages of this is that actually you're achieving savings every month, and then the ESCO is going to receive performance-based income. The project is going to be operating. And as we can see here in the picture, the client is on the right side. The client is actually just receiving from the ESCO the implementation of the project, and the client is paying the ESCO with the obtained savings of the energy efficiency per month. And the ESCO is taking care of the loan with the bank and the fixed repayments to the bank, right? So this is the operating way, the share savings one. Next model, guaranteed savings model, is also the ESCO. But here, the purpose of the ESCO is to guarantee savings on the end user's energy bill. So the building owner's bill per month of electricity, this is where this is going to go and play. There are going to be guaranteed savings there. And actually, the ESCO is assuming technical risks. But in this guaranteed savings model, the client is obtaining the financing from the institution. Let me show you the picture to make this clear. Here, the client is at the center and is actually obtaining the financing at the left with the bank and repaying that. And the client is, paying to the ESCO based on the savings per month. And the ESCO is still implementing the project and providing saving guarantee. So it's a bit different because of the financing with the one before. It depends on the needs of the client at the moment in time. Then we have the Super ESCO business model. And the Super ESCO is like the entity that is going to be an aggregate entity, mostly created by governments who are actually running on lower risk than normal investors and building owners. This Super ESCO wants to function as an ESCO for the public sector, like an ESCO of ESCOs, right? Meaning the Super ESCO is going to allow huge project financing for smaller ESCOs. So like the government is going to create this entity for it to give access to easier financing for the smaller projects to happen together. So if the projects are aggregated, which is the point of this presentation, to aggregate projects, then these super ESCOs are going to access international funding, climate finance, or some different energy finance to drive the smaller energy efficiency programs in the public facilities. In this case, it's going to be a larger scale implementation, and there are many diverse leasing schemes with the public sector, that can be used with super ESCOs. The older model that we're going to talk about right now is not similar to the ones before. It's just it has a different way of working. It's more for remote and residential areas sometimes. But the point is to also work on energy savings. So let's say that the consumers do not really have financial resources to give up from payments or access finance. The pay as you save model is going to allow them to access cost effective energy upgrades, energy efficiency installations, or anything. And they're going to pay a tariff through their electricity bills. So, meaning I don't need a credit or a financing thing happening because I don't have access. And then just month by month, with my energy savings, I'm going to be paying that tariff slowly. And then as I'm paying, I'm saving. And then I happen to access this energy efficiency technology. So for low-income consumers in more remote areas in developing countries, this one is actually working well because we don't need to be having to show credit performances to the bank or more complications sometimes with these projects, depending on the city we are, the place we are, right? So basically the PACE financing model is going to allow me to be a client that uses investment upgrades, and there's going to be a meter site, of course, that tells me per month how much I'm saving, how much is this recovering, and the capital provider and the utility company are going to be using the model to finance me like this way with the savings. It's just a different way of doing things than before. So I'm jumping into, because we don't have a lot of time, to the main barriers we found in the study for this energy efficiency bundling models in municipalities when applied in practice, most of them in Latin America, Africa, the examples I'm going to talk about later as well. There are many financial barriers, like limited borrowing capacity and credit worthiness. That's why we sometimes use the PACE model instead of just a normal ESCO. Or there are many high upfront costs, or the perception of high risk in many municipalities that, this investment is really high risk, so I need to aggregate or do something. Or technical capacities in many cities, and the familiarity with these technologies that are changing all the time, that are really new. So all these things can be covered by ESCOs sometimes, and it's easier to have an investment with someone, the company that makes this happen, that is experienced with that. And the market barriers are always there. The high transaction costs of the finance, the uncertain regulatory frameworks in many places for energy, like, for example, in my country recently in Latin America, there's a policy saying that if it's energy efficiency, it's not going to have the subsidies that it used to have before, or the tax exemption. So in this case, this becomes expensive, and I'm kind of not willing to spend that much as I was doing before because of a policy. This is an example, right? And per business model, there are also main barriers. The traditional ESCO model can have unpredictable energy saving benefits for certain projects. Like, we cannot really predict sometimes what's going to happen in the building or with the technology itself if it's very new. Or, of course, limited financing access, which is actually one of the main things. And that's why we go for older models of combinations like the pay as you save on the right side. The super ESCO model is limited more for government and public authorities, and it's a large group of projects to be aggregating. And the financing access depends a lot on incentives and policies or funding from international sources. And with the pay as you save model, many people don't know it. And even if the model is kind of better for people with low income, sometimes the technologies and the familiarity, the access to these technologies in this place at this time is just not easy to, there's no way for it to happen, or there are many things going on. So local conditions, it depends on that as well. It's a barrier. Okay, so I just have 5 minutes. I'm gonna jump into the final example here, the one in Brazil. I prefer jumping to the example I want to share you here in Spain. All these models actually can have innovative financing schemes, right? The point that Xianli is going to take you through right now is that we want better finance for the energy efficiency technologies, right? And right now, on-bill financing, energy savings, and ESCOs and pay-as-you-save are actually one of the models, but right now people are even using crowdfunding or home-based financing when they don't really have access to those models, like participatory investments. And this is gaining momentum in Portugal and Spain, in many cases right now in Brazil, for public lighting, for, let's say that a group of buildings together that want to have access to the same heating technology, right? So, but they don't want to apply to financing and they want to do something different. So they create a community, like here in Laguna del Duero in Spain. There's an intervention by a private company that owns the buildings in the area that are actually multi-property family buildings. And they decided to get a loan from Triodos Bank that was a sustainable loan. But actually, all of them together as community participatory investments, it was like an easier loan for a lot of people together. So the contract was signed, and this was about heating, and it was financed through a loan during the scheme. I'm going to show the next slide. Retrofitting mechanism. The point is that they needed more efficient district heating in this area, and the buildings were privately owned with multiple owners. They needed approval, but there was an investment coming with incentives by the European Union. So this was a policy helping them. And with this innovative model, they were actually aggregating and accessing the finance. So the loan happened, and the project is saving energy for the community together, for the residential area, and it's a good example of another model. So I'm going to finalize with this.
Good morning, everyone. I will talk about financing energy efficiency projects and bundles in municipalities. This actually also apply, although the presentation is more targeted at municipalities, a lot of the information can also apply to energy efficiency projects by other owners. So my presentation will cover the following aspects: municipal energy efficiency project, and what are the preconditions for a project to get financed, and what are the options. And among the options, first is budget funding by the municipal government and grants that can be from international or national government authorities. And another part is off-balance sheet funding solutions. Part of it is also like what Jorge just mentioned, the ESCO model. So from ESCO model, you can get a project, but without directly paying for the cover the upfront investment. And other sources including commercial credit and development credit, and also mechanisms for financing and implementation of energy efficiency projects. This is especially from the public sector or from the government, how you make a sustainable long-term arrangement to make sure many energy efficiency projects can be funded and implemented. And finally, chart how you go step by step and select the right financing solution for each project. Generally, what are the preconditions for successful financing? First, a municipal's payment for energy use needs to be on current consumption. In some countries and some places, when the government sector do not need to pay for their energy efficiency, energy use, this make it very difficult to make energy efficiency projects financeable, because such energy efficiency finance is mainly based on the cost saving, and without even energy cost, it make it very difficult to such project to be financially attractive. Also, the energy prices should reflect the real cost of the energy. If energy very cheap, that make your energy efficient projects long payback period or low return rate. That's also make it difficult to do some such projects. Also, stability of energy prices. Energy prices, if your energy prices fluctuate a lot, that can affect the energy revenue flow from the saving. So that also increases the risk. So such a very clear policy or government guidance on the energy prices, that can also make reduce the risk of such projects and motivate investment. Also, another aspect, very important precondition, is the government budget. It need to allow for the different budget lines to be used. The government can have control with that, because if the government have different budget lines, like one part is for investment, the other part is for energy expenses, and they do not need to cover use. So that if government have no control to use this energy saving to cover the investment, that also make it difficult to do such projects. So these kind of government lines, whether the different budget lines are in some extent flexible, that's also a precondition for such project to be successfully financed. In terms of different financing, you can see different, when you have a financial market, that also depends on how developed or mature is your local financial market. When the market is not so well developed, a large part will be rely on government financing or public financing. That means you have to use grant or government budget, or what Jorge just mentioned, the utilities help do the part of the financing, use on-bill pay as you save or on-bill financing. And then you can use also government to use the revolving fund. Government set up a fund, so different projects can use such fund to do the investment. When they save the energy, they pay back to the fund. So in this way, revolving funds can help a lot. Also, public and super ESCOs. Because public and super ESCOs, they have the government's budget support, policy support, and also the government somehow guarantee. So that make it they are considered less risk, and also they can help governments pull the human resource capacity and the financial capacity. So this is in some situations, quite a few countries are try this super ESCO model, because it can be a quick starting process for ESCO development. And the credit lines with the development bank. Sometimes development banks have some credit lines for energy efficiency. We know some developed banks, including the international development banks and AFDB, they do have such credit lines. And in some cases, you have the commercial banks and also government or international agencies. They can provide some risk guarantees in case such projects fail, the guarantee fund can help repay the loans. So that's also a way. And in some other parts of the world, they can have issue bonds, government bonds or corporate bonds to do it. And another type is like vendor credit or leasing. It's in some cases, especially today, some suppliers or sellers, they are willing to give some like credit. You do not need to make the full payment. You can pay with installment. So that can be also a way to finance, cover is at least, especially some credit, some equipment purchase cost. So you do not need to get all the investments in place upfront. Instead, you can pay with over a certain period, make different installments to pay it. Of course, the more advanced commercial banks are willing to have higher capacity and are willing to finance such projects, have more expertise or capacity, they are more willing to finance energy efficiency projects. So main factors influencing the availability of financing models is first a municipality's financial strength and credit worthiness. A few years ago, we had a bigger meeting in New York with different banks and talk about how energy efficient financing. It's interesting to hear from the banks themselves. Even in the US, many energy efficiency projects, they get loans not in the form of a project credit. Instead, you have that as corporate credit. The banks give such loans not because they believe in the project itself. It's more based on overall evaluation of the borrower's overall credit worthiness. So if your municipality go out to want to get some loans or finance, it's the municipality's financial credit worthiness, whether it's have a steady revenue flow, that kind of financial position is important factor when banks or financial institutions give such loans. And the predictability of revenues and budget transfers. Budget transfer a lot is about whether you can transfer between different budget lines, as I said before, because many of the energy efficiency projects need some investment in the facilities or the public buildings, but then you get the saving from the operational budget. It's like the energy expenses, whether there's such different, you can use the energy saving to cover the investment. That's also different jurisdictions, different countries have different rules, and also predictability of the revenue. As I said before, energy prices, if it's a very stable, that make it easier to predict. So that kind of also the energy use, whether it's stable from year to year, that kind of situation also very important. And also local legal and regulatory framework. So different countries have different rules. Some countries may forbidden have different rules regarding whether municipalities or public organizations like a school or hospital can they get some loans for their energy efficiency project. Of course, also a commercial financing environment, whether such commercial finance is very mature, a lot of options or competition in the markets, different options. And also, of course, the different energy efficiency project bundles or projects themselves. Different projects use different technologies, different scopes, so they're including their returns are quite different. So what is the technology risks? The different how many actors are involved, the coordination. So a lot of the project itself also affect this, and also local implementation capacity. To implement such a project, you need effective coordination, people familiar with the technology, how you use them to measure, to make sure like the project deliver and get this kind of management capacity and financing capacity, and also different delivery mechanisms. So you have this kind of either a project vehicle or different arrangements to make sure the project can be implemented, especially what we talked during this training series. A lot is bundled. Each single project, the saving may be too small to be a standalone. Then you have to combine different projects, a different project at different sites together as a single project to get it financed. So one part, the first option, when municipalities have a project, identify a project opportunity and seeing, okay, this project financially attractive or it's for other reasons, it's important, they need to do it. So the first thing when they come to finance, they need to check how much their own funding to do it. So budget funding or grants able to do it. Partially because in most cases, bank loans, they won't, especially commercial banks, they won't give 100% loans. Also partially because in many energy efficiency projects, you do not have that kind of, because the return is more based on the revenue. So you may not have the needed mortgage to get it, to collateral or mortgage to get the loans. So you need to think, okay, how you use part of the government's own budget funding or grants to reduce the risk, perceived risks for commercial loans or financing to come in. So that kind of grants can come from national or regional funding or international development agencies. Also, they can, when cities do such a project, they can also select whether they give this package contract here a general energy services provider company to do the whole process, the procurement, installation, and the construction, the whole project, or if they have the competence and they can do part in-house, they can also do this different different company for different parts of the activity. Some part maybe only for the construction, and some part like do the auditing and designing different steps. So you have multiple contractors to work on this same project. As I said, sometimes municipalities face this situation. They cannot use their budget line transfer issues or other issues. They cannot directly go to the bank to borrow money. So one of the options is through these off-balance sheet funding solutions. That means what Jorge just said, the pay-as-you-save model or ESCO, the guaranteed saving model. So ESCOs come and with their money and expertise, they do the investment, and then they get the payback of their investment through the saving, and after a certain period, they transfer the project back to the government. So that kind of way to do it. And also that's also another situation also important is for energy efficiency project. If you before the investment, you need to have a reliable prediction or calculation about how much returns you can expect from such a project. So for that to work, you need a very detailed data about the energy, water consumption, the building use, or different data related to assess the project. So the government agencies or institutions, they are ready to share the data also during the project application to calculate the saving. They need to have meters, to have monitor, okay, reading the data. So you have such reliable data. What's the original consumption or energy bills, and what's the new data after the project implement. So that's also very important, whether a company or third party can come in and check this. That's also a very important condition for such off-balance sheet funding solution to work. As I mentioned before, this kind of off-balance sheet kind of financing options, including ESCOs, ESCO using their own funding or because their expertise and financing strengths, they can come in and identify some project that is profitable for them, so they can have a contract, enter into a contract with the government and do the investment and get the repaid from the energy saving. And in that way, government gets their energy efficiency building improved. Sometimes that's also have many other benefits apart from economic benefits. It's like indoor comfort. When you have better insulation, you can have better indoor comfort. And social benefits, like you have better street lighting. That's also important for safety, and people can have more outdoor life during the night. So another way is on-bill financing. On-bill financing is just what Jorge just mentioned, pay as you save. So utility company can, especially utility company, has a bigger role to play here because they have they have many customers. They know the energy use bills of different organizations because they are the main energy provider. So they can also make sure they know how each customer their record of payment, so that they have this data and also this supply relationship, so that may reduce the risks for them. So one on-bill financing is also very popular in many countries, especially this it's a way to get the data, get the inside information and the finance. And other off-balance sheet financing options, like I mentioned before, vendors credit. Sometimes the sellers or suppliers, they are willing to say, okay, you do not need to have to pay the full price of the products or equipment when you get it. You can pay for it over a certain period of time in different installments. That can be a way of partially finance or reduce the energy efficiency project, or reduce the upfront immediate requirement for funding or investment. Another way is green leasing. Green leasing is working in some countries and cities. It's like companies lease out energy saving equipment. So instead of government do not need to pay some big equipment, instead they can lease it and pay instead of paying the investments, they can just paying the cost through leases. So this allow also building owners and municipalities to get the equipment without paying the full cost of the complicated investment or the financing process. Of course, finally, there's a commercial credit and the development credit to borrow the money from development banks or financial institutions. Because often, like sometimes commercial banks or financial institutions, they are motivated to do such projects. Sometimes is such projects, if they know familiar with the area, the risk can be not so high. And also this green image or social responsibility. Internationally, now there's a lot of talking about banks what kind of projects banks should invest in or lending money to or pension funds, different financial institutions. What is the environmental, social, and governance responsibilities? What are green they should more work on? So this is also opportunities for municipalities who can get some funding, and also also the like municipalities, how much they can borrow, how much they can go to banks and borrow. Some cases they can use their tax revenue as a mortgage or way to promise guarantee they repay the borrowed money. And in such cases, maybe there are also some legal or government regulation restrictions, and also credit rating. Whether this government they have properly managed this kind of credit level, or they have some collateral that can help the project get funded by commercial banks. Before also when you think about the whole process, either whether the municipalities, the project owners invest in such projects with their own money or they borrow from others. One criteria whether a project is bankability, that means the project have enough, is robust enough, both from technology and revenue perspective, so that it's not so risk, or the risk level and the revenue level are matched, so that you can attract some ethical company to come in to invest in it, or some external investor in or founders interested in it. Also, the financing is often a final step in the project. Actually, in the project opportunity identification and project development process, you already need to consider how to make the project, select what kind of project, both in terms of technology or coverage activities, so that that project is less energy, lower risk and higher returns or payback period. And also the technical and economic assessment, of course, is when you do this, you need to have this like a normal project financial economic feasibility study to make sure, okay, this project, what is the revenue, what is the cost, what is the return period. So you have all these calculations, data collection. And now, once you have such a project, you go actually today, if you talk with the financial sector banks, they often say, actually, we have some financing, a lot of funding is not never lacking. We lack the right quality of projects. So you have through the process, talking with banks, make sure your project align with the requirements. That's also important to aspect to do to attract the attention of banks and financial institutions and get the money. So when you think about the projects, often like this risk and return trade-off. Normally, the lower risk, lower return, banks or financial the lenders they can accept. When your project have high risks, when people think this is a lot of risk, often they will expect high return. Otherwise, they will think they would rather go to some low risk project. So that kind of when you think about to get the project, you need to assess what's the risk level, what's the return level. So try in the process, try to reduce the risk to make the project more attractive to the financiers. Also, risks, how you manage the risks. One is risk is what's the when you evaluate a risk, one is what's the occurrence probability such a situation occur. Like if you say my project will get money back from the saving of energy, so you need to think, okay, what's the energy not getting so much energy saving? What's the probability, and how much such a, if it occurs, how much it affects on the project's economic performance. And the project owners need to have effective risk management measures. It can be done like a project scoping in the project design itself. You have such a kind of considerations and screening, leaving out the risky part. Or you have some collateral and or guarantees for the loans, so the financial institutions feel like in case such risks occur, events occur, they can have some way to recover their money. Or you buy insurance. In some countries, there is energy efficiency insurance. So project owners can buy such insurance. So that's also a way to get the financiers or the lenders covered. And there are some different mechanisms or other mechanisms to consider, like the public-private partnership. International use have the sort kind of BOT model, like the company, private sector actor come in to build or invest in the project, then they operate, get their investment recovered, then transfer to the government. So such kind of different public-private partnership models can help municipalities leverage the private investment in their projects, and also in institutional capacity building, like you have the public super ESCOs or revolving fund, and also education capacity building, like energy efficiency. Implement, you need the energy auditors, energy managers who are able to come in to check what kind of project opportunity it is and how to do it day-to-day management or of such energy efficiency projects. So education and capacity building is also an important aspect. And there are also some like super ESCOs, the different continuous improvement. In quite a few countries, they are trying super ESCO because super ESCO, when the government inject fund, like India's ESL and a few other countries, the government gave funding so that the super ESCO, they can go out, help the equipment with their expertise and then finance. They can help to do the procurement, do the tendering, so and get the project implemented, audit and the project implementation. So this process. Another way is revolving fund. The government set up an energy efficiency fund so that different projects can come to the fund, get partial some of their funding, so the project can be implemented. And when they in the process of operation, they can repay the fund. So this kind of constantly revolving fund can help, and also development credit lines and risk guarantee. That's our different. Some countries try development credit lines. Some like a World Bank. In some cases, they give the loans to some local commercial banks, so the local commercial banks can lend the money to local projects. So that way they can support a local energy efficiency project implementation, and also some cases they give this risk guarantee. So when, especially in the early days, when companies or ESCOs are not so experienced, such risk guarantee can help give that confidence to the different market players, so the energy efficiency project implementation can go ahead. So super ESCO is really a way to quickly start the process, and yeah, there are quite a few countries like India, Saudi Arabia, Armenia, US, Belgium, the UAE. Quite a few countries are trying this approach, and they have a dual role. One is such super ESCOs, they can support the capacity building, and also they can once they can also engage some of the projects with private sector ESCOs, so make sure the energy efficiency project implementation can expand and scale up. Revolving fund, quite a few countries have tried this. It's a quite effective way. So the government set up a fund, so the different projects, once their opportunities are different projects developed, they can get help from such fund to get the projects funded and then implemented. And education and capacity building. Energy efficiency implementation, it needs the collaboration participation from many market players, from equipment suppliers to the project energy auditors, to identify opportunity and design the project, and also during the implementation process, data collection. So a lot of this different technicians to come in to get the project properly renovated, or is retrofitting equipment installed. So a lot of repair and maintenance, all these kind of different professionals or technicians, they need a proper training and capacity building. And also sometimes also the banks, they need to get familiar with water energy efficiency projects so that they are more ready to lend money. So this kind of, especially energy efficiency in project implementation, one important part is the energy audit. Basically, the energy auditors come in and they can check what are the quick opportunities, identify, then they work further to do the detailed audit for each equipment to have a detailed idea about how the energy is used and what kind of potential for each aspect of implementation and what's the return rate. So they can have identified different technical options for energy efficiency improvement. So this kind of energy auditors play an important role in the energy efficiency project implementation. So the World Bank actually, they also support many energy efficiency projects implementation. So they also have some concluded and have done their own study, especially through the ESMAP. They find that financing options for energy efficiency actions in municipal buildings include own budget fund and public finance by national and regional governments and the international organization fund, and you have dedicated energy efficiency funds or commercial financing from banks and private investors. So this some cases country local government are allowed to issue some bonds to finance such projects. So that's what are the factors influencing the different financing mechanism. Is different projects really suit for different financing mechanisms. What financing option is the best? So one is the project owner's credit worthiness. As I mentioned before, in many cases, when a bank come to say, okay, whether I should lend money for your project, when it's an energy efficiency project, when they are not so familiar with, they often use the corporate credit, not based on the project itself. It's based on project owner's overall financial situation and the predictability of the revenue, whether you have a steady and reliable revenue from the saving and the local legal and regulatory frameworks, whether it's allow for the municipalities to borrow and to use transfer of budget through different budget lines and the implementation capacity. How you make the project implementation, which actors are involved, how they coordinate with each other, that's also a very important factor. So in the US, some experience from the US is they have one of public sector is called the Marsh Market. It's the municipalities, universities, schools, and hospitals. These are the public institutions. And often such projects, they mainly rely on self-funding. So it's mainly rely on the finance, the funding from these organizations. And sometimes they can get loans and through escrows to help do it. And often the private financing in such energy efficiency is especially driven by government, national, local institutions. The regulations, sometimes the government have some mandatory requirements, like financial institutions have to support such kind of projects. So that's one main motivation, financial institutions engage in such kind of loans. So this is illustrative when you think about, consider what kind of financing option for your energy efficiency project. One is your project itself, what's the characteristics, risks, the potential, and another is what's the financing situations or the options the municipality have for different projects. You can see whether it's building retrofit or insulation, different with changes through change to efficient boilers or chillers. The risk level, technical level, capacity, whether it's complex or it's the investment needs, how much you invest you need, and the payback period. Some kind of projects it have a longer payback period. Some projects has a much shorter payback period. During this training series, you also hear about street lighting, public lighting. Often that is have a relatively quite short payback period. So when you have different kind of payback period and technology capacity, you need to think, okay, what's the project its own characteristics. Then you think about the local municipalities' own financial options, whether they have strong credit and their borrowing capacity, or they are having how much they can cover with budget financing, do they have some energy efficiency funds where they can go to seek funding support. So these kind of situations you need to consider when you decide what is the best option for your project. Finally, this is a World Bank's chart on how you, through this yes/no chart, you consider, okay, what's the best financing option for your project. So first you consider, okay, do we have enough, the municipality have enough funding to fund the project? They say, yes, we have enough funding. So you do not need to consider, okay, we do not need to go out to borrow money from anyone. If not, then you consider, okay, do we have some grants from donors or national or available from national government? If yes, you try those sources, or you say, okay, is there an energy efficiency fund? Then maybe you can go to check whether your project is eligible for such getting funded by such fund. And then if that's not available, those part is more the public part. Then you need to think, okay, go to the commercial banks. And when you go to the commercial banks, you need to consider what is the financial credit worthiness of the municipality and what's your project. Can you match their lending requirements? So that's the commercial lending part. If not, then you think about, okay, what about off-balance sheet funding? Like, are there ESCOs which can help increase the investment in the projects? Or is leasing or vendor financing options available? And also this can we issue some municipal bonds? So you, through this kind of chart, you consider all these different options to see, okay, how to get the project funded. Of course, in reality, often a project is not often rely on multiple sources of funding. So maybe you can consider, okay, I have a municipality will say, I have some funding, own funding, but it's not enough. So where can we get more funding? So you check through this process and whether how the target is to get the project funded and implemented. Thank you. That's the end of my presentation.
Thank you very much for your presentation, Xianli and Jorge. Now it's time for the Q&A session. As you can see from my slides, please use the dedicated icon to send us your question. And I'll start first with you, Jorge. The question we received is, what innovative business model for energy efficiency would you use in a rural area with almost no access to financing or credit?
Right, so the question goes into energy efficiency in a rural area where, access to finance is actually lacking and there's no really access to the technology. So in that case, I like the example of the participatory aggregated bundling example in Spain, where all the community members design a scheme where they can access together, let's say 10 houses together, an example of a financing scheme that is not using credits, which they cannot access. So it could be like a PACE business model that applies energy efficiency into those, collective owners. So in this case, there's more chance for energy efficiency technology to be available in this case. And of course, the company is going to be able to bring them the technology per month, and they don't need to have credit worthiness, or make up from payments for that to happen. And yeah, there are ways that this is evolving right now, such as in retrofitting as well of buildings, which is just repairing and renovating as well with energy efficiency technologies. Instead of accessing large-scale finance, there are smaller ways of participatory finance in the community of the buildings, like we saw, where there's possibilities, for upgrades, right? That's the discussion.
Thank you very much, Jorge, for your response. Now, the next question, I'm not sure if it is for you, Xianli, or for you, Jorge, but please, we have an open microphone. And the question is, how easily accessible are the platforms for capacitation in the knowledge of financing mechanisms in rural and marginalized communities?
Yeah, I think thanks for the question. It's quite interesting. Of course, there are this kind of the financial market is really depends vary from country to country, from situation to different projects. A lot, I think, especially the development funding or the international, if you say international funding or development funding, especially public sector, maybe when you're marginalized or that have a lot of social impacts, this kind of projects may be more suitable for this government grants, or is like the development credits or international grants. This kind of funding more care about these social benefits. Maybe for commercial funding, often they think more about the risks, the returns. So maybe that's less available. Jorge, maybe you have something to add?
Yeah, I agree with that. Right now there are many more ways to access the community in rural areas than before, but there are, of course, still many funds that haven't been coming for those projects to happen, and the financing schemes and the microfinance schemes actually that are interesting are making this happen more and more. And in my opinion, just adding that, in my opinion, it's getting easier because of those technologies that are bringing in together the microfinance and the whole ESCO things into those places. Right now it's evolving, so we need more time to see if this is going to be easier. Of course, we're like at the early process sometimes. Mm-hmm.
Thank you both for your responses. And the next question, I think it's for you, Xianli. And the question is, how is credit worthiness in municipalities assessed while seeking financing for energy efficiency projects?
Yeah, as I said, that really depends on some situations. The financial institutions also whether they are able to evaluate the project's own risks and levels and the returns. Sometimes then they can make the project-based finance. So they give the money, they lend the money more based on the project itself. In some situations, whether the project risk are high or the local financial institutions lack the capacity to evaluate the project's own risks and returns. Then they look at the credit worthiness of the project owners to use the corporate finance. So that kind of situation, they more consider the credit worthiness of the municipalities. Also, you can see the municipality, this credit worthiness is mainly for the loans. When you have off balance sheet kind of escrows, or you have the energy efficiency fund or the grants or own funding, you do not need to consider. Especially this is a relevant question when you go to commercial banks to borrow money, when they cannot really evaluate the project's return and it's not enough to cover its risk level, or the local financial institution lacks the capacity to do that kind of assessment. They rely on the municipality's credit worthiness evaluation.
Thank you very much, Xianli, for your response. It seems that we already ran more than we anticipated regarding that event. So I would like to say thanks to the panelists for the informative and interesting presentations, and to the audience for their active participation. We hope that the presentations will be beneficial for all stakeholders involved in energy efficiency. Thank you for your attention and wish you a good day from the sunny Copenhagen.